It's Tuesday, November 21st, 2023, episode 20. I'm Patrick Serezna with our weekly Market Huddle plus 30-minute catch-up interviews with past guests. This week, we have the pleasure of welcoming back Pinecone Macro's founder, Chase Taylor. We'll be discussing his macro views on the stock market rip, the dollar weakness, and run through some of our favorite commodity trades. Let's get Chase on the call. Hey, Chase, how are you doing?
Doing great. How's it going?
I'm doing great and better now. I always love talking charts with you, and there's so much to talk about that I wanted to get you back just to pick your brain on what you're thinking of what's happening here in these markets. So let's jump right into it. I have this chart of the S&P 500 up here, and we saw arguably one of the greatest flips in years. Just the magnitude of like this 10% market rip where CTAs were all short, everyone was getting sell signals, everyone was bearish, and then they got squeezed in the big way. So I mean, it rips. But what's next here? Is this just the market doing what it does best and just ripping everyone's face off with a rally to wash everyone out? Or is this something more? Do you think there's upside here?
Yeah, but like for me, it's more of like rentable upside. But I do think at least into mid-January, you're probably just going to keep melting up. The rest of the year, we're going to have less and less humans, to buy or sell, and more programs that have to buy for any number of systematic or passive reasons. So my assumption right now is we keep kind of melting higher. I think obviously the viciousness of the move higher, that part's over. It'll be a slower, lower vol kind of move the rest of the way. But it was the perfect trap, though. I have to say, we closed that week under 4,200, which was literally everybody's line, and then the next week just started on the rampage. After the QRA, of course, which we're all experts on now. But yeah. So I think we just continue to melt
now.
For a while.
The Nasdaq 100 is already doing a direct retest of its previous high, and the Russell though has been the dog. It not only broke to its summer lows, year lows for 2023, but this is much more of a retracement than it is a continuation of a bull trend of some sort. Do you think the small caps continue to underperform here?
Yeah, I do. Obviously their squeeze was that much more violent than anything else. But at the end of the day, until short-term rates start actually moving down, they just have a problem. I don't think people realize, but 30% of the Russell has floating rate debt, and 40% of the Russell doesn't make money. That's a pretty nasty combination. So my guess is it keeps leaking lower unless rates start to really plummet. But even then, in whatever environment rates are plummeting in, it's probably not great for the economy, and the Russell's a little more economic sensitive than Microsoft.
Right. And so my kind of perspective is that we're going to have some sort of a pause and retrace, because that's what the markets typically do, maybe to a 50-day moving average or something that's just a typical pullback. But do you think that the S&P is capable here in the next month of going back to the 2021 highs near 4,800, or you think that this is much more like another 100, 150 points to go in a slow crawl?
That's a great question, and I honestly don't know. I'm 50-50 on that. I could see it either way. I know the move to a new all-time high would offend me more, so that's probably going to be it. But I could see it either way. I could see it just kind of like retesting the highs from earlier this year, but I could also see it going to 47, 47.50 and then falling. But I would not be shocked if we had a prairie dog all-time high.
There you go. I love the terminology. All right, so let's talk about the dollar here for a moment. Obviously, in this kind of risk-on impulse, the dollar began correcting, but it's becoming almost like the drop is almost accelerating to downside. Obviously, there was a rip in the Euro USD coming right up in towards some resistance levels from highs throughout earlier in the year, but really really, obviously, the big move has been in the US dollar yen, which put in a little bit of a topping, or at least a heavy formation at the high, and finally broke that upwards channel that it's been in. Now, do you put this in the category of just a correction in a primary uptrend in the US dollar yen, or do you think that this is a more meaningful upper resistance level that's going to mark a more of an intermediate high?
So I don't think, a secular top is in the dollar by any means. Whenever it comes to dollar yen, though, I think the top is in. If you just look at the monetary policy kind of differential moving forward, I mean, everything the yen competes with that way is going to be cutting rates next year, and they're probably about to start a hiking cycle, which just sounds weird to even say hiking cycle about Japan, but because of that, I really think, and because of capital flowing back into Japan being a reasonable likelihood, I think the yen can keep moving. Now, obviously, carry adjusted, it may not be a wonderful trade if it goes slow, but I do think the yen's going to keep moving higher.
By the way, do you have a opinion on Bitcoin? Like, this has been quite the rip on the upside. Obviously, the crypto kids are very excited at this stage, and obviously, it's been a very nice trend for months now. Do you think that this still has legs? What are you looking at here in Bitcoin?
Yeah, long and really liking it, and I like the fundamental picture. For Bitcoin, just supply and demand wise, as all these flows come in for ETF buying as those are about to launch, and most of Bitcoin's in pretty sticky hands at this point. But I will say I kind of hate the chart. My one of my least favorite charts is whenever something goes straight up and then has like a jagged sawtooth, like 50, 70 degree angle, and it's exactly what it's done. Because usually when you break that angle after you went straight up, like it's usually a pretty nasty pullback. But at the same time, like as long as you're above the 31,600 level, then really it's all good, because that was like a really big base for a long time. So to me, that every day above 31.6 is a win for Bitcoin.
And
so I'm going to be bullish as long as we're above that.
Conveniently, that's right at the 50% retracement, right?
It's funny how that always works, right?
Isn't it? And so it's one of those scenarios that even if there was a pullback of the 15% variety, it could very easily be bought on dip and still be in a primary uptrend, right?
Yeah, and you don't even have to sharpen a crayon to draw the uptrend line that it's been in for the last couple months. So you can try this one at home, folks.
Yeah, there you go. They just a little thicker crayon might still help, though. Let's talk about what's happening here in the precious metals market, because gold just decided today to poke its head above 2,000, and the first time that we've seen some of these gold miners actually react, because it was surprising. It seemed like the gold miners have been in the doghouse while gold's been having a pretty good couple months. What do you make of this turn up today, and what's your overall view here on gold?
Yeah, so I'm glad you nailed it, because at the end of the day, like, we've had this great run, and I've been largely ignoring it because the miners have been ignoring it. So exactly what you're talking about is exactly what I've been watching for. Whenever the miners started to take it seriously, I would take it seriously. So I think that's important. For me, the 2006 line is kind of my line in the sand. It's really on a monthly chart, at least. It's like capped the candle bodies for the last like 3 years, 2 years at least. Yeah, no, actually about 3. So that's kind of what I'm watching, and we're like right there, kind of testing it. So we're very close to what I would consider a big breakout for at least the way I do my technical analysis. If we get that and miners confirm, then I think you're ready to run.
Right now, do you like, for me, I think that for at least for this year, just it retesting the high of the year near 2060, 2070 is probably a realistic outlook for like a 1 month target, right?
Yeah.
But the bigger question is, obviously when central banks inevitably pivot to an easing cycle, that typically has been an environment from which precious metals have done really well. Do you think that the central banks? Well, first of all, it's pretty clear that they have paused. Are you in that camp, or do you think that there's still room for one more hike?
No, I'm definitely in the pause camp.
Right. And
I think we've had 100, 200 basis points of policy error already, personally. So if we do another one, it's just a little bit more. I do think financial conditions loosening up is probably making them a little nervous, but yeah, I think they're done, and I think the data we're going to get between now and the December meeting is going to make that pretty clear. I'm still not convinced they'll come out and plant the pause flag in the ground, but or the we're done flag. I'm sure they'll keep the optionality until
oh,
unemployment scares them.
yeah, that's 100%, right? Like, why would they give up the optionality there, right? And especially in an environment where the equities are rallying this way, the last thing they need to do is put more gasoline on the fire to keep things ripping. But it's certainly a good go. Now, are you more bullish on any of the other precious metals over gold? Like, obviously, silver had a nice little reversal, but nowhere near its highs. But generally, it's been behaving half decently. But you then also having a quick peek at platinum and palladium, you can see it did its little turtle head formation to a lower low, turning back up, and palladium has been such an ugly chart, just bouncing a little bit. Is there any of these that you like a little bit more, or is gold really where your focus is?
I in this particular instance, I actually like silver more, and that is just because I personally I just have a really clean downtrend line going back to the 2011 high, on a monthly chart that we're so close to breaking out on. So from that standpoint, if that breaks out, that's a pretty big deal to me. But so what? Because I don't trust myself to get it right on either one, I'll probably just play both, roughly 50-50, and see what happens.
But how about the other ones? You're just not leaving them alone?
Yeah, especially, I mean, palladium's been just a total dog, as you mentioned, but it did hit its 200-month moving average. I'm afraid of those because as EVs kind of gain more and more market share, like it just kind of hurts because you don't need the catalytic converter material anymore, and obviously auto sales are just kind of rough to begin with.
Right. So let's move on to the energies. We'll cover. We'll start with crude. We'll talk gas and as well uranium in a moment. But let's start with the crude oil. And obviously, geopolitics played a role. But I mean, we were up at $95 before the Middle East really intensified. And obviously, they call it a little bit of a war premium and things like that. But obviously, it became a consensus trade to be long energy as things heated up there.
Yeah.
And then came the big washout. And like it's clearly been a very ugly month on the downside of oil. I mean, what's your take here on how things played out and how you think things where the trade is on this one?
Yeah, so to me, this actually is normal. I have a framework where whenever you have something geopolitical or something just real newsy, to make up a word, I like to fade the first order effect and then what I call buy the third. F3 B1 or F1 B3. I said it's the way I kind of frame it. So I kind of figured oil would get hit because everyone was buying it, and that was only going to go up if Iran got directly involved. It became clear to me, at least relatively quickly, that Iran was not going to get involved. So at that point, it's worth fading oil. Now, I did not think it was going to go down this far. I think some of this is actual global growth, U.S. growth, starting to hit a little bit. And then, so at the time this is going on our podcast at Bulwark, I was saying, what fade the first would be was just no, don't buy oil. And the third order effect, what you would want to do is go buy Israeli stocks. They got smashed for a little while, actually hit a trend line, and they've ripped since. So they've dramatically outperformed oil since. And at the end of the day, I mean, they're going to have to print a bunch of money and hand it out to people and to contractors and everything, and their inflation is going to go up. So their equities are going to go up. So to me, that was not that difficult to kind of see coming, but I thought maybe, flat to down 5-10%, something like that on oil, not the violent move we've had since. I think we got oversold and overdone on a fundamental standpoint. CTAs and hedge funds finally got excited and started buying oil, obviously just in time for this trapdoor. But now they've all pretty much jettisoned it, so you can move higher now. The only reason we have moved higher in the last couple of days, though, has just been the OPEC rumblings, which to me, OPEC doing more cuts here is a mistake. They're going to have so much spare capacity soon that they're going to cap oil prices for years. So that's concerning if you're an oil bull, in my opinion.
Right. So, I mean, more or less, that puts you sort of in the trade range camp where, let's say we get back to 90 and then work our way back and forth like a ping pong between support resistance levels. Is that sort of your framework?
Yeah, I think you're pretty safely in this. It's a big range, I'm about to say, but 70 to 100 is where you're going to be stuck for, maybe for 2-3 years, unless even in a recession, in my opinion, you can hold 70, unless it was really bad. But I think that 70 to 90 especially that's new normal.
Yeah, it's kind of, when you think back to how oil played out in 2007, 8, and 9, it was obviously oil played a huge role in contributing to breaking the market into a recession as it was doing a face-ripping rally and squeezing consumers. And then, of course, it went crashing down during a huge, demand shock in the middle of the recession. And it's funny, oil doesn't seem to have a big role this time around. Do you think it is just going to be a nothing burger in this cycle?
Yeah, it's really difficult for me to see it jumping on a rocket ship to help usher in the cycle. About 6 months ago, I thought that was very possible. And then we did move from, the 60s back up to the 90s. And I was feeling really good about that little thesis. And then it just completely petered out, of course.
Yeah. All right. Well, let's talk nat gas. And I actually shared your view when you were on the show last time because I thought that was developing such a solid basis, the January contract, by the way. And just it gave out. Like that support line gave out, but what's shocking to me is not that the support gave out, but it's just the speed and velocity from which the selling is now coming in. And the thing is that while this is the winter gas contract in January, but even when you look, I like this ETF, the UNL, which looks at the whole 12-month strip, and like the entire strip collapsed on the downside. Like
these 24 has broken down big time.
Yeah. So what's your take on what happened here? And is this actually going to ultimately be an opportunity, or is this now a leave it alone kind of?
Well, I hope it's an opportunity because I've been buying. So I never like go within 6 months of the front month in gas just because it's dangerous. So I like to buy like December of the year or two out. And I've actually been buying May because you can get a lot of withdrawals even January, February, March. So I like to get those springtime contracts to capture a long winter, which I don't think is impossible. At the end of the day, we had a just really nasty storage report last week, and that's what tipped us over. And production just refuses to go down. So the production numbers and the gas storage numbers are really bad. And that part's totally fair. But when I look at weather, I thought November was like back half of November was going to be warm. At one point it was, and the market didn't really care. Now all of a sudden the back half of November, the models look pretty cold. Same with Europe. So at this point, I think gas is mispriced both in the U.S. and Europe. So I've been a buyer. I'm buying more December 24. I'm buying more May 23. And I'm actually going to look to build a pretty big position, I think, probably in 25, because in the U.S., we have a lot more LNG export stuff that's going to open up next year. or at least some point in 2025. So to me, it's just that much more. You just have no margin for error whenever you have the LNG exports that we're going to have. So
So
yeah, I'm a
this is
buyer.
where this is where I want to pick your brain for a moment, because obviously we're both technicians and the charts matter. But when I see this magnitude of selling on the downside, it's a very, very ugly chart. But you are immediately turned to a lot of fundamental reasons why
Mhm.
this price is cheap. But do you just directly buy into the weakness based on price level alone, or do you actually have very specific technical approach to when you do this buying, or do you like average in your position at a level like it? Do you want to share sort of the way
Sure.
you think about it?
So 9 times out of 10, my trading has a very technical, at least underpinning. It's only if I have a lot of conviction in fundamentals on something that I'll basically ignore it. Because let's be honest, you look at these charts, I ignored it. But with that said, I just don't go aggressively all in on a bad chart. So something like this, I'll go find longer term support, and then I'll layer in buy orders between where we're at and that longer term support. So right now, let's say on December 24 contract, the 200 week, there's sort of a like supply demand like zone where you went sideways for a while and then shot up. So a demand zone, and then the longer term uptrend line. All three of those kind of are between 350 and 370, and we're at 402 right now. So the way I see it is we're very, very unlikely to go under, say, 360, 355, something like that. So I'm happy to buy a little bit now because I feel so strongly on the fundamentals. Layer in some orders between here and there with a decent cluster right at those levels. And then of course, hey, we break below 350 or whatever, then I'm just wrong, and I'm just going to eat my loss. And it won't
Right.
be a fun loss, but
Well, good luck. I want to see some sort of a evidence that the bleeding has actually stopped and based before I dip my toe again after cutting out. But it's certainly a trade that's on my radar. But let's talk about the trade that did work, and that's uranium continuing to rip. The U308 contract is above 80 now. And uranium continues to just be on fire. I know that generally you've been leaning bullish on this with a high conviction. What's your thinking now, and do you have an upside target to these types of trades, or are you just holding for the ride?
so this is one I've been holding for the ride since 2016. I've consistently added to uranium and haven't sold any. But my rule to myself all along was that once we got over 100, I would start trimming. So that's the plan. Whenever we get over 100, I will start, you know, giving the ducks a little bit of bread. I'm not going to want to, but that's been my plan all along. So I'm going to stick with it. But I think the overshoot possibilities in this market are just so significant. The price insensitivity of the utilities that will buy this material is so big. Like it's such a small part of their costs. It just creates wild overshoot potential as we're basically playing musical chairs, and there's not enough chairs. The music stopped and no one's realized it yet. I do think maybe even in the last week or two, you're starting to finally see the price action that suggests maybe at least one person realizes what's going on here. But Cuppy did, obviously a masterful job of kind of explaining the musical chair situation after he went to the conference where there's not enough material and somehow no one realizes it yet. I I think the upturn in the price lately, how straight up it is, it suggests maybe people are figuring it out. But I think 200 is very much a possibility. I I hate making these
Yeah.
big calls of things tripling and all that kind of stuff in it. But on uranium, I think it's possible. But you got to have rules, and my rule is to start at least selling some over 100.
There you go. We have only a few more minutes. Let's just quickly hammer off a couple of the softs because we've talked about cocoa before, and this thing just has not stopped.
Yeah, we're at basically like a 50-year high.
Yeah, it's just
That's it's one of the best letters we've ever written. Was November of 2022 saying to buy this. On the flip side, we stopped participating a couple months ago, so that's been dark. But yeah, I love ags because if you can get the weather right, you can get everything right. And on this one, it was literally just a weather trade. It's been awesome.
And another one that's still up along its highs is the sugar contract, which is still hovering along those highs, but getting heavy. It really doesn't have any more upside momentum. Is this a late stage trade in your mind?
I'm torn. I think we can have another leg higher. But at the same time, because of the way the chart does look, the way it does look a little tired, a little bull flaggy maybe, but also a little tired. Yeah, I think you can have another impulse higher. One I definitely want to check out is soybeans. That's one I feel strong about of late.
Really, eh? Okay, well, let me just get this up here. There we go. So yeah, it's obviously been basing, and so you think that the lows are in on this ag story?
Yeah, I do. I think corn and beans both, but I just really like beans can have a really nice move higher, and that this is a trade I feel like can work for actually maybe years, but especially in the next 2-3 years.
Now, I'm going to ask an ignorant question because I've never known the answer to this type thing. But when we're talking about economic cycles and things like this, how sensitive are grains to economic cycles? Because people generally will eat during recessions and stuff like that.
Yeah.
But so, the question is like, is there any relevance to that? It was a liquidity driven. Like, how do you approach that?
I would say from a macro perspective, the thing that does matter is FX. So whenever the dollar gets cheap, it really helps all these U.S. listed ags because whenever the dollar's really high, the global buyer doesn't really want to buy it from the U.S. If they can go get it from India or Brazil or something instead, like that's like a better prospect for them. But when the dollar starts to weaken, it makes our agriculture products like really, really attractive all of a sudden. So if the dollar keeps going down, all this stuff can go up for no other reason than that. Plus, having for soybeans specifically too, like it's a big diplomatic kind of like playing card between the U.S. and China. So if that kind of keeps getting better, China will probably buy a bunch of U.S. soybeans, especially if the dollar keeps going down. But the biggest part of this is a weather trade to me. But
it's a weather trade. The question I have for you then is, I think that you implied earlier that you generally think that there's still more upside on the U.S. dollar, especially going into potentially economic recession. Does that put a short-term damper on your bullishness? Like, is this a long-term trade that you have to see past that short-term potential volatility?
Yeah, so it's like all my trades. I want it to be a long-term trade, but we'll see how it goes. But yeah, to your point, if we go into recession, say Q1 or 2 or whatever, and dollar starts to rip, if the soybeans break down on the chart, then I'll get out and start watching it like a hawk to get back into it. But it's definitely a good point.
All right. Last thing I want to touch on is this orange juice futures, which in the last week or two has just been ripping all over again. Unbelievable trend.
Yeah, this is a monster. It's something I haven't traded and I haven't done my homework on because I missed it and it made me mad. And I just didn't look. One person I'll give a shout out to on this though is Greg Weldon. He was kind of like all over this for the last couple of years, talking about the crop in Florida and how people were sleeping on how bad it could be. And then obviously, you had literal natural disasters take out a lot of oranges, but yeah, it's something I missed and definitely was not trying to short it or anything like that. But I thought it was done here a couple weeks ago, and then it just came back to life.
All right. Well, Chase, listen, you're one of my favorites to talk charts with, and you weren't a disappointment. I really enjoyed the session. Thank you for coming out. But listen, where can people follow you and find you?
Yep, they can follow me on Twitter at Pinecone Macro, and then the website is pineconemacro.com.
All right, fantastic. Well, Chase, looking forward to having you back in the future, bud.
All right, take it easy.
Yeah. Happy Thanksgiving.
Appreciate it.
Thanks for tuning in to the Market Hub Plus. Next week, we'll return with our full show. See you later, everyone. Cheers.